All right, welcome to Talk Tickers. Today we're digging into Saratoga Investment Corp. They just dropped their latest earnings, and honestly, it's a bit of a head scratcher. The company's actual value, it went up, but the stock price, it took a nosedive. So we're going to unpack exactly what's going on here. So that's the big question, right? How on earth does a company get stronger on paper, but investors run for the hills? It's a real puzzle. And to solve it, we've got to start with the numbers.
Okay, so let's get into the results. The headline numbers here are really telling what feels like two completely different tales.
First, let's look at the good news. The company's net asset value, you'll hear it called NAV, came in at $25.61 a share. Now, you can basically think of NAV as the company's book value, what it's technically worth, and it actually went up this quarter. That's a great sign, right? It means their investments are performing and the balance sheet looks pretty darn healthy.
But, a healthy balance sheet is only one part of the equation. Now we have to look at the income side of things. Their adjusted net investment income, or NII, was 58 cents per share. Now this NII number is super important. It's the actual cash profit they're making from their main business of lending money. And this is where things start to get a little tricky. Because then you have to look at what they're paying out to shareholders. The dividend was 75 cents a share. And well, you don't have to be a math whiz to see the problem here. You're earning 58 cents, but you're paying out 75. You're just not making enough profit to cover that dividend. And for the market, that is a huge red flag. And boom, there's your reaction. The market saw that income shortfall and didn't hesitate. The stock dropped over 4% right after the news came out. It was a crystal clear message. Investors cared way more about that uncovered dividend than they did about the growth in the company's book value. So this really gets to the heart of it all. You've got this tale of two stories. On one hand, you have management trying to get everyone to focus on the long-term health of the balance sheet. But on the other hand, you have the market, and all it could hear was the story about weak, short-term income. Let's break down this conflict a little more. You've got management's story, which is all about the strong balance sheet, right? They're pointing to NAV growth, fantastic credit quality, and a ton of liquidity. Then you have the market story, which is laser-focused on the income statement, the NII miss, shrinking margins, and of course, that uncovered dividend. Let's dig a little deeper into what management was trying to say. Okay, so management's whole argument really starts with the quality of their loan portfolio. And honestly, it is pristine. I mean, look at this. Virtually every single one of their loans is performing just fine. They have only one, just a single investment that isn't paying them back on time. That's what non-accrual means. And it's a teeny tiny sliver of their entire portfolio. And to really put that into perspective, check this out. Saratoga's rate of bad loans is just 0.3%. The average for the rest of the industry, for other BDCs like them, is 3.4%. That is literally more than 10 times higher. This is management's trump card. They're basically saying, see, our disciplined, careful approach is working exactly as it should. And that's not all. On top of that amazing credit quality, they are sitting on a huge pile of cash, what we call dry powder. Over $400 million, in fact. This is just money they have ready to go, waiting to be invested in new loans. And those new loans, well, that's how they're going to grow their income in the future. All right, so let's shift gears and talk about the earnings call itself. How did management handle all this? This whole balance sheet versus income story. Well, their message was super consistent, it was confident, and it all boiled down to one word: patience. So this is basically their game plan. They're all in on high-quality, safe loans. They'd rather hold on to their cash than chase after risky deals just to make a quick buck. The message they sent was loud and clear. We would rather make a little less money for a quarter or two than make a stupid loan in this competitive market just to please Wall Street. They're totally confident that once good deals pop up, they can put that cash to work and cover that dividend, no problem. And this quote from their CIO, Michael Gishis, just nails it. He's essentially saying, hey, we're seeing these bigger guys, maybe they're a bit desperate, coming into our market and offering these really risky deals with very few protections, what they call covenant light. And Saratoga is just flat out saying, nope, we're not playing that game, even if it means their income is a little lower for a while. So you might be asking, why are they being so cautious? Well, it's because Saratoga doesn't exist in a bubble. The whole private lending world is actually facing some pretty big headwinds right now. The simple truth is, it's a tough time to be a lender. M&A deals are slow, so there aren't many good companies looking for money. And at the same time, you have this flood of cash, all that dry powder from different firms, chasing the very few good deals that are out there. It's like a game of musical chairs with way too many players. It pushes down profits and tempts people to make risky moves. So for Saratoga, this intense discipline, it's their shield against a really tricky market. Okay, so how do we put all this together? How do we take the strong balance sheet story and the weak income story and figure out what happens next? What should we be looking for when they report again in a few months?
All right, so here's our take. We're initiating coverage with a market perform rating. And here's why. That fantastic balance sheet and their top-notch credit quality, that puts a pretty solid floor under the stock price. It's hard to see it falling off a cliff. But that gap in their income, that pressure to cover the dividend, that puts a ceiling on the stock for now. There's just not a lot of room for it to go up until they show they can get their earnings growing again.
So here's what it all comes down to. Plain and simple. First, what do you need to watch? Keep your eyes on how fast they start deploying that $407 million in liquidity. Second, what's the trigger that could make the stock pop? It's when their adjusted NII finally gets back above that 75-cent dividend. And third, the big thesis they need to prove over the long run is this. Can they actually put that money to work and grow earnings without giving up the amazing credit quality that makes them so special in the first place? That is the billion-dollar question for the next call. Thanks for tuning in to Talk Tickers. And as always, please remember, this is not financial advice.